Welcome back, ladies and gentlemen. A lot has been discussed about equities, but one must not forget that it's not the equity, but it's the asset allocation between equity and debt that determines 90% of the investor's overall portfolio performance. And so, the event will be incomplete without us discussing the debt asset class. As this event is organized by PMS World, which is India's most trusted alternates-focused new age investment platform with consistent focus on high-performance investing, the debt asset class discussion is going to be conducted on the fastest rising structure of private credit alternative investment funds. So, the final topic for today's discussions is expected risk reward of fixed income through private credit alternative investment funds. Ladies and gentlemen, let me take the privilege of introducing the panelists to you. We have with us Mr. Aakash Desai, the head of private credit at IIFL AMC. He has a rich experience of about 2 decades of diverse experience in institutional financial services and specializes in the areas of corporate and structured finance, syndication and capital markets, as well as treasury. Prior to IIFL AMC, Mr. Desai was associated with Clicks Capital in the capacity of head corporate and structured finance business. And prior to Clicks, he has been part of Standard Chartered Bank, ICICI Bank India and UK in various leadership roles. He is an alumnus of NMIMS Mumbai. A very warm welcome to Mr. Aakash Desai. We have with us Mr. Karthik Athreya. Mr. Karthik Athreya, ladies and gentlemen, is the head product and strategy at Sundaram Alternates with an objective to build a scalable alternatives fund business in fixed income, starting with the Sundaram AIF Category 2 fund that focuses on investing in high yield opportunities. Mr. Athreya has over 22 years of experience across principal investing, funds management, investment banking, corporate finance, assurance, and transaction diligence services. He's a qualified chartered accountant and a commerce graduate from Loyola College, Chennai, India. A very warm welcome to you, Mr. Karthik Athreya. We have with us Mr. Shekhar Daga, the head private capital at ICICI Prudential AMC. In a career spanning over 2 decades, he has handled the entire gamut of investment management across corporate lending, structured finance, private equity, special situation, and distressed debt. Previously, Mr. Daga was a partner at AION Capital and served on the board of multiple portfolio companies, including Clicks Capital. He's a rank holder CA from Institute of Chartered Accountants of India. A very warm welcome to Mr. Shekhar Daga. Ladies and gentlemen, this session will be moderated by Ms. Lakshmi Iyer, who heads the fixed income and products team at Kotak Mahindra AMC. She has been with the organization since the last 20 years and more and is responsible for credit research, deal execution, managing fund performance across all debt funds, and assisting sales and client interaction. In addition to that, she has been a portfolio specialist and managed product-related initiatives such as product pricing and coordination with the funds management and sales team in that role. Ms. Lakshmi Iyer holds an MBA degree in finance from NMIMS, and she loves exploring new places for traveling, is a big foodie, and is an ardent movie buff. A very warm welcome to you, Ms. Lakshmi, and now the proceedings are in your able hands. Please take it away, ma'am.
Great. Thank you so much, and a warm welcome to each one of you, and good afternoon to my co-panelists. It is a very, very cloudy day today, at least in Mumbai. And the Mawsam is really awesome. It doesn't really call for a private credit discussion, but that's the mandate for now. So we can discuss bhajiyas maybe after this conversation. For now, it's raining outside, but is it really raining returns in asset classes? So if we really look at 2022, which is, say calendar year to date, if I were to just give a summary of returns, debt, which is fixed income, the returns are a drizzle. I mean, pretty much every category is 2-3% percentage in terms of annualized returns. Equities are a fizzle, probably every market cap in equity, stocks, of course, I'm not commenting on that. Equities are a fizzle, and gold at best is a dribble. In that kind of a scenario, and again, those who are pretty active on social media can relate to what I'm saying. There's this very nice rap by this American Brit which says, "My money don't jiggle jiggle, it folds. I'd like to see you wiggle wiggle for sure." So as investors, we are all actually trying to fold our money, trying to see where we can, and the markets are telling you, "I'd like to see you wiggle wiggle." So I think that's the context setting for today's discussion. The topic, as rightly introduced to you, is the expected risk reward of fixed income through private credit. Before I start off with my panelists, just to, kickstart and give you a context of the economy first. If you look at India's credit penetration, which is as a percentage of GDP, we are certainly improving. So if you see maybe 5 years back or 7 years back, we were at about 92%. Today, as we speak, we are still well below 100, but it's still about 95, 96%. But if you look at the median of economies ranging from China, Korea, Singapore, Japan, UK, US, if you see all of them, we seem to be the least. And the median would be somewhere around just about 200% or maybe even lower, with obviously Japan being on the higher side. So clearly there is an opportunity. While we, as I mentioned to you, we have seen credit penetration improve in India over the last 4 to 5 years. But clearly, if you compare India to the rest of the world, US, and of course the rest of the EM world, there is a lot of scope for improvement. That's number one. In that, if you see dominance of certain set of players. It's more sporadic. It's not really en masse. So all that clearly creates, an opportunity, given the fact that Indian credit markets are still at its nascency. But to understand more and deep dive into this, and to really be convinced that my money is going to jiggle, it's not going to fold, let's try to probably brainstorm this over the next few minutes. And I will start with you, Shekhar, to try to understand where exactly are we in India in terms of private credit, where we are right now, and as a money manager, managing monies in this space, how big is the scope and where do you think we can get to?
Thanks to PMS AIF World, and thanks Lakshmi for the quick intro on the subject. So I think private credit, if you look at it in India, and as you compare with global markets, be it US, which is much more developed, I think we loosely use private credit because in India, credit means credit. People don't think there is a performing credit, there's a distressed credit, there's a high yield credit. Private credit is a very wide span. So you start from a 11-12% kind of a transaction going up to early 20s. So I think we need to kind of segregate these buckets. And my belief is that if you think of the entire market in India, I think it's a new word which we are just coining it, but this has been present in India, where earlier the industrial institutions were giving this kind of capital, then you followed by the mutual funds and the NBFCs. But over the last few years, as we had a credit dislocation in the market, the private credit continues to be there, but the players in the game have changed. So today you will see global funds, global banks, and now we are seeing a flurry of or asset management companies coming with a credit funds actually. So it's not that private credit was something which was not there in India. It was there, but played by different set of players. And now the way it looks like going forward in future, this is the right way to play it, because it's a very different risk reward as compared to a kind of a high grade credit actually, what investors are used to it. So you need a kind of a different kind of a platform. So AIF is a much better platform, which is close ended. So from that perspective, if you look at it, we believe like this is going to grow. And now when you size this market, if you look at today, and there has been a report last year itself from EY on the private credit market, and I kind of agree to that segment. There's an annual flow between $15 to $20 billion of private credit. Now, again, this private credit will range from 12% to 20% across sectors, across strategies. But if you look at it, this market is going to grow maybe a slightly higher rate because the Indian companies or Indian promoters are capital starved actually. And that has been the case because we don't have a view like if a Indian promoter has his stock, can he monetize it by way of streaming more dividend than what is regulatory allowed, or can he do borrow and buyback? So those are the nuisances for which the Indian sponsors is kind of a credit at their personal levels or a structured credit in the operating company to provide the equity for the next leg of the growth actually. So with India expecting to grow at a much higher growth rate going forward, and as the credit growth over the last 6 months we have seen is reaching double digits, I believe that this private credit as a spectrum will also grow in the same size. And if we think of the market, maybe the annual demand can go from at least 15 to 20 billion dollars to about 30 to 40 billion dollars in next 4 to 5 years. And when you think of what is the current pool of assets, if you look at it, I personally believe you add up the estimates, because there is no data available, but it is about 50 billion dollars of private credit which has been built as a book by various firms or funds over the last 3 years. And this book eventually can go about $100 billion.
I'm not able to hear Shekhar.
Yeah, I've lost him as well.
Shekhar, can you hear us?
I can.
I think your connection is bad. If you can switch off your video and continue, we'll be able to hear you better. All right, while Shekhar, fixes his connection, I think one interesting take home, apart from the optimism that Shekhar shared, is that this industry is poised to grow from $15-20 billion to maybe close to $30 billion. And on a lighter vein, since it's a Saturday afternoon, I must say that at least we as fixed income money managers still have our jobs. So I think that was the other small takeaway I had from what Shekhar rightly observed. When this credit opportunity, as we are saying, is probably at its nascency or tip of the iceberg, getting to be there. Aakash, I wanted to get from you some perspectives on what kind of depth we have in this market. If you see in equities, you have retail, you have HNIs, UHNIs, institutions, FPIs. So what kind of depth we have? Are there sufficient market participants ranging? And of course, is there sufficient liquidity in the secondary market? Can you give us some color on that?
Sure, Lakshmi. I hope you guys can hear me okay. All right, fantastic. So, here is our take on how we see the market unfolding, right? So, the exact size of the opportunity or the excitement of people in this industry is primarily because there is a massive supply-demand mismatch, right? Today, private credit or structured credit or bespoke solutions, you can call it by many names. The reality is that there's very few players in the market who are actually catering to this niche, I would say, segment. And I'm saying that because, if you see most of the, and I think 2018 was a cataclysmic year or a year of tectonic moves in terms of, it reshaped a lot of capital supply in the industry, right? Up to then, you had banks being more aggressive, you had NBFCs and mutual funds obviously dominating this market. And it was still a largely, I would say, flow plus, or a yield plus kind of a market. No one was attacking private credit in the way that people are looking at it today and the way it's poised to grow. Post 2018, whether you call it market forces, you call it pressure from stakeholders, rating agencies, leverage providers, or even stock market valuations, right? A lot of the capital providers before this industry kind of, I would say, polarized themselves to picking one or two niches, right? So most of the banks, NBFCs, mutual funds move towards the high grade or the high quality names. And hence, one could call it there was a slight flight to quality. And a lot of the NBFCs and asset management houses move towards the more distressed end of the segment, given the opportunity to make much, much larger returns. That has created a large white space. And we are, in our understanding, this white space is today, like Shekhar said, in a good case, $30 billion in size. In a base case, $30 billion in size. in a good case, where there's, India 5 trillion economy, lots of domestic capex, lots of refinance. So if all of that plays out, we think this could be as large as 60 to 70 billion dollars of capital that will need a home. Today, we think that home comes from the large sort of global funds playing actively from offshore, some of the foreign banks who again look at a very small niche, and that leaves a huge space for people like AIFs, asset managers, to really grow, scale up their business models. And I think even within this, there is specific niches, right? So one can look at the lower end of the spectrum, which is still, I'd say, reasonably safe, promoter financing, AA minus, A plus type of names. Or one could divide this private credit market into two spots, or two segments rather. The first segment being the, so to speak, mid-market segment, or what we call the missing middle, which is essentially people who've, 1,000 to 4,000 crore turnover companies, historically had one or two PSU banks, who are unable to keep pace with the capital requirements, or not able to provide flexible or solution-oriented capital. And these guys are looking for growth capex or refinance or PE exits, right? So that mid-market space becomes one large opportunity. In this segment, I don't think there's anyone looking at this segment as a specific focused target market that leaves that vacant area that I was talking about. And the second is what I call episodic or point-in-time transactions, which are the large structured opportunities, companies going private, PE exits in large holdcos, things like that, where or there's a new capex coming on stream, and that needs certain amount of last mile financing. So these are larger groups, easier credits, larger balance sheets, but also need non-dilutive, flexible capital, right? And that's where I think funds will play a role. This specific, I'd say, structured or large credit market is being attacked by the foreign banks, is being attacked by some of the larger funds. But I think if one can really scale their strategy within these two sort of separate areas, and we think both of the areas are large enough by itself, right? So the unserved mid-cap segment, according to us, is anywhere between $22 to $24 billion a year. This is a year of financing. And the large corporate space is very, very large. I mean, if I look at the numbers, the refinance amount coming to the market, which previously was done by someone like a mutual fund or an NBFC, that itself is 8 billion, right? And this is per annum. So I'm talking about organic, regular demand. Now, if you add to that the expected private sector capex or the public sector capex, or if I add to that the PE investments into India or PE exits into India, all of which need, I'd say, solution-oriented financing or non-plain vanilla pools of capital, the opportunity is immense, right? And unless, I think, insurance companies, unless large amount of global funds, or what we call patient capital, steps in and solves for that demand, we think a large part of demand is going to get unmet. So the flip side or the positive side of that is, there's a massive, massive opportunity. People who will attack this, display track record, raise capital quickly, and you're able to deliver scale, I think will be the largest beneficiaries. And to that extent, we see newer players entering the space. Now, you asked the question, Lakshmi, in terms of investor appetite, right? So today, I think the investor appetite largely comes from HNIs, family offices, ultra net worth clients, and probably some large sovereign wealth funds and kind of global institutions. We're yet to see allocations within large domestic asset managers, allocation with global fund of funds. I mean, some of the larger European mid-cap family offices are itself $8, $10, $15 billion in size, right? Today, all of them attack India via a small allocation in an Asia fund, but not specifically something looking at India. We feel that will happen over the next 2, 3, 4 years. And that could really scale up, or what we call explode this market, because then supply and demand will kind of try and keep pace with each other. So till insurance companies play a part, till global asset managers play a part, we think there's a massive runway for this space over the next maybe 2, 3 years.
No, I absolutely agree with you, Aakash, and I think a big shout out there. This is our fixed income version of Rising Stars, and as they say in equities, catch them young and watch them grow.
Will them grow?
This is one
Absolutely.
such yeah. This is one such
Absolutely.
this is one such opportunity that we have. Karthik, I wanted to get some sense from you in terms of are these largely what plain vanilla structures, simple and boring and yet complex in terms of the underlying and consummation of the process, or do you think there are innovations available in this space? And also to give some color, is this globally? Are we at par with what we are in terms of our product offerings in this space?
Sure. Thanks, Lakshmi, and thanks, PMS, as well. And I just want to quickly add on because I think my answer will be relevant if I make a few points. Both Shekhar and Aakash articulated very well, where we are at the moment in terms of private credit. What I feel, and from what I hear from investors who put money into our fund, which are indeed a combination of insurance companies as well, aside of the high net worths and family offices. One of the things that even international investors, based on our conversations, appreciate is that India, from a risk-reward perspective, is still probably one of the few economies which offer, consumption-led or whatever it is growth, and it is still one of the few economies that is perceived as having beaten or trying to beat inflation, because if you see everywhere else, it's quite the reverse. So from that point of view, as you started the conversation, an under-levered economy, or rather, I would say not an excessively levered economy, and a growth assumption on top of it. Most of the financing that I've seen, and indeed what we do in private credit, which is a combination of real estate and mid-market lending, is performing oriented, is growth oriented in some form or fashion. So the answer to your question is private credit continues amidst all the funds and the supply demand gaps, etc., to be oriented towards some form of growth capital, where historically over the last 5-6 years, we've sort of tried to fill in spaces, and indeed over the last even 15 years, where private equity has not been able to play. Public market equities have not been able to play. So, those have been sort of stopgap villages, aside of, the whole brokerage-led, financings like loan against shares and promoter financing and so on and so forth. So I think, with all the sort of global events, what has happened in India over the last 5 years, clearly, and one of the root causes of private credit emerging as an asset class in India, I think, we are as Indians, consciously or subconsciously moving as an economy towards typically the Western world, where the whole supply of capital structure is inverted, where banks actually play a very minuscule role and largely do traditional forms of financing, social financing, and the non-bank, which comprises whether it's organized lending firms or funds or alternate investment vehicles, including SPACs. It's no surprise that US is 95% of the SPAC market in the world. Essentially, that's 70-75%, and traditional forms of financing are 25%. India is probably one of the few places which is the inverse, and it's really 75% bank financed market and 25% non-bank. So as 10 years ago, this was 15-85. So as that ratio begins to improve in favor of non-bank or alternative credit, this asset class as a whole is likely to increase. And because of the genesis of how India is sort of getting into this financing market, the form of financing that most private financiers look at, including ourselves, tends to be traditional plain vanilla secured instruments. I mean, to the extent possible, and this is a big nebulous word, secured, because different people have different ways of looking at the word secured. And there could be so many funds which are structured as mezz, as quasi equity, which believe that by way of structure they have some sort of downside protection. And then there are, of course, the more plain vanilla secured instruments where you're secured by assets. As the Google definition of private credit is, you end up owning assets in a way that you can do loan to own. you have tangible assets, could be business assets, could be promoter assets. But essentially that's, more of the sort of distinction, that is available as a format in the market. Within this, I've seen structuring largely around things like tax, things like cash flow, how do you get to security in a whole co-op financing and so on and so forth. But it is towards very, very specific purposes, one or all of them. Haven't really seen product innovation because to your earlier question to Aakash, I do believe, based on what I'm seeing in other markets, especially in places like Europe and the US, India does lack, and we are in very early stages. And this is really a positive thing to say. It's not a negative thing to say, but we do lack depth. We do lack, symmetry in terms of information transparency, which is why there is massive premiums for liquidity from a domestic return perspective. We do have almost no leverage, that is juicing returns for private credit funds. If you see the US or even Europe or Singapore or even Dubai, you have super attractive leverage structures that juice an 8% return to a 16% return. And so, private credit funds really are the talk of the town. But in India, by regulation, AIF category 2 funds cannot lever. So essentially, that sophistication and the sort of willingness of SEBI, the RBI, to actually allow funds to lever is not there, simply because there is an onward lack of, I would say, clarity in terms of what are creditor rights. And even now, in real estate, you have RERA giving dramatically different judgments in Delhi, Bangalore, Bombay. So essentially, it becomes a very, very I would say, difficult thing to sort of base a strategy on. If you, for example, if you look at construction financing in Australia, it is so clear set. And you can end up making a 10, 11% dollar return, eyes closed, with no problem and significant equity below you at LTVs of 40, 50%. So that is simply impossible to achieve in India because, what is LTV is a big question. But having said that, how do you actually get to the asset is a very prolonged process still. But I would say that, having participated in the distressed market in the mid-2000s to 15 years later, I can see that, there is a lot more clarity, at least in terms of being able to prove judicially that, you have clear creditor rights and, courts won't dispute if you've written your documents well, that, you are indeed a creditor. Equity disguised as debt, different problem. A lot of the offshore structures got caught in that and very difficult to prove. But I think we're getting there from a trend point of view. The other point I would like to point out from a local market private credit point of view is the significant presence of both commercial and regulatory arbitrages. So, there is a commercial arbitrage in terms of what banks are historically willing to lend to, how they've changed behavior from relationship to transaction and how that's impacted what they do. And, then clearly restrictions of RBI on what they can and cannot lend to, size of balance sheet that they can actually attribute to a sector. So there are mushrooms or pockets of opportunity that private credit funds can, play significantly because there is automatically a regulatory arbitrage business. And that has mushroomed into a whole bunch of innovation on product, whether it is, through structuring, what kind of end users you target. And of course, always the structuring motto, at least, I've looked at in the past and Sundaram indeed follows is, are you an equity risk and trying to protect yourself, or are you a credit risk, trying to sort of ring fence your investment? And so a lot of the structuring I've seen here, but, a lot of the products that I see offshore, for example, I recently spoke in one of the panels in London, where my co-panelist was a guy who was doing trade credit financing in a fund structure. And he was largely dealing with the agricultural and commodities business. And he was doing, 1 year, 1.5 year financing and making, 14% dollar returns, on high churn sort of trades. And, and he's simply able to do this because the geographies in which he operates, have that creditor protection, have that teeth, that he can actually put a company into bankruptcy very quickly if they don't honor it. And he was obviously backing on, good level rated credit and paper. So the ability to also put together, financeable structures, where, you have, a rated piece of the underlying, that you can package with a plain vanilla structured credit and then add security of the promoter. And all of those things are quite complex to be able to put together because just executing a day-to-day business is complex as it is. But I'm quite hopeful that there is a significant amount of opportunity, and Aakash and Shekhar alluded to billions of dollars, and our own estimate is probably, I'm quite glad to hear those numbers, because we ourselves pegged it at a little lower, but still sizable demand supply gap in terms of capital that we can cater to, and it's a sustainable set of businesses that is enough for many players to play in. And if you actually add the capital that between Aakash, Shekhar, and several others, in the market today, it still is $4-5 billion on an annual basis short of what the demand is. So essentially, there's a lot of room, for players who are quick, nimble, able to structure instruments, and you can do the structuring around tax, and you can do the structuring around cash flow and security. But a lot of the innovation in terms of levered returns, specific product-related innovation, how do you sort of do CLOs? And from an India perspective, even securitization, slight sophistication, not have to go to derivatives and so on and so forth. But if you do slight sophistications, is something that I believe could occur in the next 5 to 10 years as capital markets deepen, as bond markets get more liquid, as retail participates more in secondary market bonds and so on. That can actually get pretty interesting. But as of the moment, I see a lot of the products either across equity-related structures or credit-related structures, and you may have packages that sort of make sure that there is reasonable protection structurally or by way of asset in either case. And so that's the way I look at it.
No, perfect. I think, Karthik, the point that you raised on the regulatory, that was in fact the thing on my mind as well. As the industry is growing, as the size is growing. Shekhar, this question is to you. What or where are we in terms of the regulatory framework right now in India? While I do understand, and we all understand that the size is quite different, are there any best practices that we can get from the rest of the world where this market is slightly more evolved? Any color on that?
Sure. Can you hear me now? Thanks. Sorry for the disturbance earlier. So yeah, I think Karthik did cover some parts on the regulatory aspect. So we have started with a good base actually to think of it. So alternate investment platforms which SEBI has approved is a very good base to start with. And I think we are still in the learning phase or early stages as these kind of platforms mature, and as we do transactions or work towards originating trades or kind of transactions which are available, we see some kind of a nuisances or challenges, which I think over a period, I think it will kind of develop upon. So one of the basic things, if you look out on the alternative space, whether it's a debt or a equity, these are all mostly closed-ended platforms actually. In India, we don't have a secondary market for any of these places. So today you have invested for a 4-year lock-in product. You can't go out actually. Globally, there are secondary funds who kind of do play this. India, we are still in early stages because once you have a secondary market for these papers as well as the investments, I think we will get more investor interest because then it's not like a lock-in product. I think one thing which Karthik touched upon is the tax arbitrage actually, and a lot of our transactions we have to maneuver around to have a tax arbitrage. And that is something we need to get AIFs on a level playing field with other platforms, be it a mutual fund or a PMS. There are still some arbitrages left with some platforms. And that actually makes a big kind of a difference when an investor is committing a capital to a AIF, whether it's in a private credit or equity. So I'm sure it's an issue for every, but more specifically on private credit, where you don't have large upside volatility. So any tax saving is a big gain for you actually. One important thing I think which is there is US, and since I worked with the American firm earlier, so the credit funds out there have the flexibility to buy securities and loans. In India, if you look at it, be it a mutual fund or in AIFs, we can't invest in loans actually. And as an AIF, definitely we believe there has to be some flexibility for us to participate in loan platforms. So can we buy a loan from a bank or something like that, or participate along with them? Currently, it is pretty much a non-convertible debenture or something like that. That is the case which we have. And the last space is more specifically on the co-investments. Globally, if you look at it, there are larger deals. Suppose I have 1,000 crore deal and from fund I can invest 200. I will raise co-investment from my existing LPs who will come along in these transactions. In India, it is slightly very difficult to create the structure because the current AIF format doesn't provide a co-invest within the same platform. You need to either get them directly or in some other way. Globally, if you look at it, if you have an FPI built out of Mauritius or Singapore, you can create structures where your global LPs can come in the same platform along with you and invest as a single transaction. So I'm sure the regulator and everybody is considering these points. And as we go forward in future, a year or two, a lot of these kind of things will get resolved. But yeah, to start with, yes, we have a very fabulous base where we are starting from. And I think that's the right way to start. And I think these tidbits and puzzles can be added and resolved as we move forward.
Absolutely. I think the base is fantastic. And, as they say that jahan hum khade rehte hain, wahin se line shuru hoti hai. The funda in fixed income is jahan pe sovereigns ya AAA bonds ke yield khatam ho jate hain, wahan pe hopefully wahan se private credit ki line shuru ho jati hai. So on that basis, Aakash, I think a risk topic is never complete, or an asset class topic is not complete if you don't really bring in the returns picture. So what should be, an expectation in normal terms? Of course, I'm not talking about supernormal or volatile times, but what should be a generic return expectation if our viewers, should keep in mind, and they should, when they're deciding, when they have to allocate money to any of your funds, what should they keep in mind, and what should be the returns ballpark region be?
I give a Lakshmi long answer and a short answer, and try and explain the logic of both. The short answer simply is the way we pitch it to investors is: look, I mean, we're in a rising interest rate scenario. Inflation is not going down in a hurry. Look at fixed private credit as a inflation hedge, where you get, I'd say, liquids, and I know liquids is a wide band. I mean, I'm not talking about Desai here, but liquid FMPs, or we used to have FMPs in the past. But 400 basis points to 500 basis points pick up over FMPs on a gross basis should be what you look at. If you get tax efficiency, then obviously that's the icing on the cake. But that should be the ratings, or that should be the returns base that one should look at. Anything above that is obviously fantastic, given the relative risk mitigation parameters will be different from investors to investor, right? The long answer of it is this, right? I mean, we now have about 3,500-4,000 families or family offices invest with us, and across the board, I've seen varying degree of the risk reward threshold being sort of the equilibrium changes for lots of investors. You've got a bunch of investors who are fairly savvy, who understand the markets, who are happy taking the relative risk reward trade-off in favor of higher return, given, like you rightly outlined, Lakshmi, that fixed income returns are a drizzle right now, right? So everyone's looking at this space more attractively. And I think given returns from listed equities have been sideways at best, private equities, we're at the really top of the cycle. People have talked about froth and what have you, right? So I think investors are fairly smart and savvy to the extent that whilst principal protection is an ask, most investors are happy anywhere between 13 and 14% gross, right? Anything better than that is like I said, the icing on the cake. I think that will change over time as the market evolves and develops. I think we will see people create niches within the private credit space, right? Be it sectoral, be it thematic, be it structuring, and we'll have, for example, a few NBFCs and funds target only, let's say, financials. Few people target old economy industries. Few people target, let's say, REITs and InvITs as an asset class, something we're extremely, extremely positive about, right? So the risk reward trade-off will change for each of these areas. But I think broadly, today, most investors look at post-tax returns of at least maybe somewhere between 9 to 10% for a medium duration fund. And I think if that can be delivered, investors are walking away saying, I'm at least getting post-tax 300 basis points, pre-tax maybe 500 basis points pick up over what I can get in liquids, right? I just wanted to add one last point here. Again, this risk-reward trade-off will change once we see large amount of institutional participation. And I think the question to Shekhar that you asked earlier, or also to Karthik, was about regulatory sort of the ecosystem, right? I mean, from our perspective, I think we think that SEBI's done a fairly decent job, or fairly good job, I should say, of this whole AIF. We've seen how AIFs have picked up. The industry now, to our math, is about 5.5 lakh crores across all AIFs. And we're going to see that growing rapidly. But from a pools of capital perspective, I think a lot more freedom or jurisdiction needs to come into passive or patient capital players, right? I mean, most insurance companies have rating criteria, they have equity treatment criteria, which actually inhibits people putting money in debt AIFs, right? So if you look at AIFs as a segment, as a broad brush, most institutional investors either look at it in one risk class and not really slicing risk into saying, is it an AIF which is investing in, let's say, startups? Is it late stage venture debt? Is it doing equities or is it doing credit? And I think once investors also get more and more used to what they're seeing and the market evolves, they will start driving return expectations, because clearly the benchmarking will come into say a Cat 2 fixed income credit AIF is probably safer and a good risk reward balance vis-a-vis some higher riskier asset classes, right? So, to my mind, these are the two key drivers of return. And I think if I were to go back to SEBI and if this was a wish list, I'd say allow institutional participation to come through, whether that be PFRDA, whether that be IRDA, and also let banks designate some pools of capital for making investments, which probably has a higher CapEx requirement. Like the DIB business globally, right? So most global banks, whether you look at Europe, the US, Singapore, have this DIB pools of capital or designated investment business pools of capital, where the CapEx for that book is inherently higher. So the regulator understands these are higher risk categories, so you provide more capital against it. But the banks are free to manage that pool of assets themselves, and insurance companies and asset managers and fund of funds, right? So once that ecosystem sort of becomes more, I'd say, market efficient, the whole risk reward dynamics will change. And I said the last point I want to make is, the fund of funds construct, right? Today we probably have a very minimal or absent fund of funds platform in this country. People don't. I mean, there's sort of two concepts of picking asset managers, right? In the equities world, from what I understand, it's the star equity manager, and everyone goes towards single name people who kind of drive capital raising. And in the institutional side, it's largely, if you call it the umbrella institutional cover or sponsorship and what have you, right? And that's because the market hasn't developed, hasn't seen cycles, the track record isn't established. But as you see track record getting established, as you see players getting more and more, I'd say, deep into this space, that is something that will drive. So quality asset managers who can pick well will get capital from not only investors directly, but also fund of funds. And I think SEBI's large value fund category, the LVFs as we speak, is the first right step in that direction. We're seeing a huge amount of interest from LVFs and investors happy to straddle, Cat 3Fs, fund of funds, Cat 2Fs, private credit, and the ability to play these asset classes will really, and savvier, larger investors always are the first ones to take any, to get their feet wet, if I can use that phrase. And then you'll see a lot of people jump into the pool to say, this is an interesting asset class. And managers will start getting, I don't want to use the word rated, but managers will start getting bucketed into, quality managers starting to pick or be able to raise capital far more efficiently than the others. Yes. So I think these 2-3, drivers will not only change regulations, but also change return expectations. But for the moment, I think we're seeing a huge interest in like I said, that anywhere between 12 to 14% bracket, right? And that's where people are happy with inflation plus, or I would say yield plus returns.
No, they ought to be happy, because, currently the mahal, if I were to say, in fixed income market is returns dhoonte reh jaoge. So in a dhoonte reh jaoge market, I would say 12 to 14% gross returns or gross yield is absolutely salivating. So I'm sure I'm already sensing some investors or some viewers drool over it. But Shekhar, this is the future picture which Aakash has painted. How has been the investor experience so far? Has it been in sync with what we are discussing, or reality is way away from that right now?
So I think, as I told you at the start, we need to see private credit in different parts actually performing credit and distress. And if you think in distress, if you look at the global investors' experience or the domestic funds, I think their experience over the last 5 years has been pretty good actually, because we have seen the NCLT resolutions happening and it has done very well actually. In terms of real estate, there has been a mixed experience. If you look at it, there are some funds which have done very well and there are some which have not done. Performing credit, I think I like to put more asset class, because there are very few funds which have long vintage actually. So it may not be right like they have done good or bad. But if you pick up the asset class, whether it has been booked by a NBFC or a mutual fund or a few others, I think the track record of the performance is reasonably well. And there are a lot of private transactions also which have happened, which investors have participated directly as well over the last 2-3 years. And the performance has been good. And more importantly, Lakshmi, it's more important that we are at the upcycle in the credit actually. So I hope like things, unless until we don't commit any stupid mistakes, the likelihood of any accidents will be very less actually. Maybe once the economy comes into stress, I think that two tests will come. But at least for next 3 to 5 years, at least 3 years for sure, we should be in a good cycle, and hopefully this asset class should deliver a good return, what investors have been expecting on this.
No, very true. I think the proof of the pudding is in eating it. So trying to cherry pick your asset class within the private credit space is very, very important. And on that point, Karthik, let me bring you in on, you did touch upon in quite detail about innovation, but, my final question for this discussion today is, like in equities, there is a long only, there is market cap based strategies, there's thematic, there's long short. The usage of derivatives is quite high, because intuitively the derivatives market for equities is way bigger than the cash market. Do you see similar trends coming in the credit space, private credit space here in India? Are we already there, or are we yet to be? Some thoughts on that?
Yeah, so the direct answer I alluded to earlier is I think not. And I don't think, we are anywhere close to having any sort of options or synthetic market surrounding debt, for the reasons I mentioned last, that I think in India, it's largely, when you look at credit, a hold to maturity business. And you could have pleasant surprises in terms of getting prepaid and, the underlying asset can perform better, et cetera. But I don't think the ability to create structures that allow for Western style funds to churn capital faster, create greater money multiples, and all of those exist, simply because I think there isn't that level of sophistication in the ecosystem, whether it is in terms of regulatorily allowing such structures, the ease of execution in the market of such structures, as Aakash alluded to, investors in our experience in India, want to have the cake and eat it too as well, unless you're dealing with sophisticated guys. Largely the HNI guys, are mentally not ready for high risk, but they want high returns. So essentially, one of the things why India always sort of, has shorter and shorter cycles in terms of events and issues happening, to the point of 2017, 18, and all of that stuff that happened with NBFCs and so on, is simply because I think there is a relative, I would say, how should I put this delicately, not a consistent sort of practice, of what your investment mandate is. So there are a lot of style drifts, as a result of which, you represent something and you end up doing something, and courtesy the action of a few, a lot of us get painted with the same problems. And so a result of that is, you're constantly, climbing out of a hole. If you've seen that Batman movie, you climb out of the hole and then you fall when you get to the ceiling, and so you fall right back. So hopefully, guys have learned from that, and certainly, there is, as an ecosystem, an overall growth and a push and a rising tide in terms of a lot of the macro and the micro indicators that point to sustainable performance and opportunity. So, while the big global funds are looking at stressed, distressed, and outsized returns, 20% plus, because they have to sort of average out, what the performance in the West and Asia have been. In India-specific businesses, if they don't, even if it's a 14% growth, and if they consistently deliver a 14% growth, through up cycles and, down cycles, by sticking to an investment mandate, perhaps some of these structures in terms of, being able to shorten the investment time frame through innovative, synthetics and derivatives and calls and deepening of the bond markets and all of that may happen. But I'm certainly hoping that happens. We have the raw materials, and as I said, as Shekhar said, the basis for it. But as of the moment, I don't think there is. But the compensating thing is there is a significant amount of business that you can do, at between 13 and 16, 17% in growth, because all of those pockets, whether they are SME, MSME companies, or whether they are structured solutions to larger enterprises, whether there are regulatory arbitrages like acquisition financing, corporate restructurings, some level of holdco, opco, pre-IPO, pre-liquidity, all of those opportunities regulatorily are available to be able to do sustainable business. So that's my take.
No, I think you summarized it absolutely bang on, Karthik. And while this can continue forever, I'm conscious and mindful of time. And in the interest of time, I will just summarize what we discussed over the past 55 odd minutes. There is no doubt that there is enough light in the room as far as private credit space in India is concerned, but the future continues to remain even brighter. An industry which is poised for phenomenal growth. With every return criteria, it's always a carrot and stick. So with every return criteria, please be wary of the risks in mind. जितना मिठास घोलोगे रसगुल्ले में मिठास उतना ही बढ़ेगा चाशनी के टाइप में, but that obviously brings in its own health hazards. So keep that in mind. But clearly this is a space. It's like telling someone, an outsider, saying that I'm visiting India. In India, where do you go? Then you say, okay, I want to go to this particular state. So you want to go to Maharashtra. In Maharashtra, where do you go? Then you say you want to go to Mumbai. And then where do you go in Mumbai? And then you say North Mumbai, South Mumbai. So likewise, that is the canvas of the private credit space. You have alternates in that. You have the performing credit. You have the distressed credit. You have real estate. You have all of these opportunities which are definitely worth cherry picking. The industry, as Shekhar rightly observed, is a little under 6 lakh crores or 6 trillion rupees. So we might just be probably at the tip of the iceberg. And in terms of diversification, definitely there is a scope for this to find a way in part of your portfolio. As they say, how much ever you're full on your tummy, there's always space for that dessert. So do have that small dessert space for private credits in your portfolio. And to conclude in typical Bollywood style, I'm reminded of this dialogue, by Shah Rukh in Om Shanti Om, that picture abhi baki hai dosto. So I think the private credit picture is yet unfolding. Thank you so much for a patient audience.
Thank you very much, Ms. Lakshmi. First of all, thank you for being impressively well prepared and engaging and keeping us all at the height of our attention despite it being a post-lunch session. Also, to the panelists, I'd like to thank you very much for being phenomenal in this session, for your pointed insights. Thank you to Mr. Shekhar Daga, thank you Mr. Karthik Athreya, and Mr. Aakash Desai.